So what is an R multiple? It's just a way of showing the result of a trade based on risk instead of dollar amounts or percentages. A lot of people talk about their profit and loss in dollar amounts, but there's a big part of the picture you don't get from that. It's hard to know just how good the trade actually was. For example, if someone said they made a $500 profit, it sounds alright, but you don't know how big their account size was to make that amount. They could have been trading a $1,000 account, or they could have been trading $1,000,000 account. Obviously, it was a better trade for the $1,000 account. If you display your results as a percentage of equity, it's a little better, but there's still a problem. You don't know how much you risked per trade. For example, maybe that $1,000,000 account only had $1,000 worth of stock. That's a pretty small amount of risk, but you wouldn't know that just by him posting a dollar amount or a percentage. So that's where R multiples come into play. They were first talked about in Van Tharp's book, Trade Your Way to Financial Freedom. And here's how they work. It's basically just a risk to reward ratio. R just stands for risk, how much you risk per trade. So let's look at a chart example. This will be our entry, this will be our initial stop loss, and this will be where we eventually close the position. Let's say in this trade we're going to accept a risk of $100. So $100 equals 1R. Now let's say at the end of this trade we profited a total of $650. So you just divide 650 by 100 and you get an R multiple of 6.5. This gives a much better idea of how good a trade was. For every dollar you put at risk, you made $6.50. R multiples also keep you thinking about risk management, which is definitely another benefit.